Imagine waking up at 4 in the morning to the sound of repeated urgent notifications on your phone. You rub your eyes and look at your brokerage account only to see a balance that has been decimated. Your long positions in silver, which were showing a profit of $15,000 just hours ago, have been forcibly closed. You did not sell. The market did not hit your stop loss through natural price action. Instead, you are a victim of a rule change that happened while you were dreaming. This is not a hypothetical scenario. This is the reality for over 41,000 traders who were liquidated in a single overnight session. The world of commodity trading is often sold to the public as a fair fight between supply and demand. We are told that if industrial demand for solar panels increases, or if mining supply in Mexico and Peru drops, prices will rise. But there is a darker secondary layer to this market that most retail investors never see until it is too late. It is a layer where the exchanges and clearinghouses act as both the referee and a player with a vested interest in the outcome. On this specific Monday morning, the Chicago Mercantile Exchange, known as Comex, decided to raise the margin requirements from $22,000 to $25,000 per contract. To the uninitiated, a $3,000 increase might seem manageable, but in the world of high leverage and professional futures trading, this was a tactical nuclear strike. This 14% increase in required collateral meant that thousands of participants suddenly had a massive capital shortfall. If you were holding 10 contracts, you needed to produce $30,000 in liquid cash within a matter of hours. For many individual traders and even small hedge funds, that liquidity simply was not there. The result was a forced liquidation cascade of historic proportions. As the automated systems of major brokerages began hitting the sell button across thousands of accounts, silver prices did not just dip, they collapsed. We saw prices in the global markets plunge from $88 per ounce to $74 in a heartbeat. This was not because the world suddenly stopped needing silver for electronics or medicine. It was because the rules of the game were modified mid-match to favor those who were positioned for a crash. In this deep dive investigation, we are going to peel back the curtain on the Comex margin hike. We will examine why this specific timing was chosen and how it protected major institutions that were facing a catastrophic short squeeze. You will learn about the secret gravity of the $75 strike price and why 41,000 call options represented a systemic threat to the paper silver market. Most importantly, we will discuss how you can identify these regulatory traps before they snap shut on your capital. The silver market is currently a crime scene, and if you want to survive as a trader or investor, you need to understand exactly how the evidence was manipulated. Welcome to the reality of the global financial power structure, where the most dangerous move isn't a market crash, but a change in the fine print. To truly comprehend the magnitude of this event, we must look at the cold, hard data across the two most important time zones in the silver world, Shanghai and New York. The crisis began in the East. As the Shanghai Gold Exchange opened for the morning session, silver was trading at approximately 8,620 yuan. When converted to U.S. currency, this represented a staggering price of roughly $88 per ounce. For months, the Asian markets had been leading the way, driven by massive industrial appetite and a growing distrust in paper currencies. However, as the clock ticked toward the New York Open, the environment shifted from bullish enthusiasm to pure chaos. The Chicago Mercantile Exchange, or Comex, dropped the hammer. By raising the initial margin for a single silver contract from $22,000 to $25,000, they effectively pulled the rug out from under the long side of the market. This was not a slow bleed. It was an instantaneous execution. Within hours, the price in Shanghai plummeted from 8,620 yuan down to 7,680 yuan. This represents a drop of nearly $8 in a single morning session. In New York, the carnage was mirrored with clinical precision. Silver opened near $80.50 per ounce and was immediately driven down to $75.68. This 5 to 6% crash had absolutely nothing to do with the mining output of Mexico or the demand for silver in electric vehicle batteries. It was a liquidity event. When an exchange raises margins, it creates what we call a forced selling loop. Traders who cannot meet the new cash requirements are liquidated by their brokers. This forced selling pushes the price lower, which then hits the stop-loss orders of other traders. This in turn triggers more selling, creating a self-reinforcing downward spiral that feeds on itself until the market is purged of all leveraged buyers. What makes this specific crash so suspicious is the concept of the spread. Only 24 hours prior to this event, the price difference between Shanghai and New York had reached a record $8 per ounce. This spread told us that physical silver was in much higher demand in Asia than the paper contracts being traded in the West. Usually, arbitrageurs would buy in New York and sell in Shanghai to close this gap. But the spread remained wide because there simply wasn't enough physical metal available to move across the ocean. By raising the margins in New York, the Comex successfully forced the New York price down, which naturally dragged the global sentiment with it. The spread compressed from $8 down to $5 almost instantly. This compression did not happen because New York found more silver. It happened because the buyers in New York were legally and financially forced to abandon their positions. We are looking at a market that was disconnected from the reality of physical supply and demand, and instead was being governed by the administrative decisions of a clearinghouse. To the 41,000 traders who lost their capital, this wasn't a market correction. It was a targeted liquidation of the very people who were betting on the physical reality of silver's scarcity. To the average person, margin is simply a financial tool that allows for greater purchasing power. But in the high-stakes arena of global commodities, margin is the ultimate weapon of the invisible hand. To understand how 41,000 traders were neutralized, you must understand the mathematics of leverage. One standard silver contract on the Comex represents 5,000 ounces of silver. When the price is at $80 per ounce, that single contract controls $400,000 worth of metal. Before the rule change, an investor only needed $22,000 to control that $400,000 position. This represents leverage of approximately 18 to 1. In this environment, a mere 5% move in the price of silver can either double your money or wipe out your entire deposit. When the exchange moves the goalpost by increasing the margin requirement to $25,000, they are not just asking for more security. They are intentionally tightening the noose around every leveraged participant in the market. The Chicago Mercantile Exchange and other clearinghouses justify these moves by citing volatility. They claim that as prices become more erratic, they must increase margins to protect the integrity of the clearinghouse from defaults. However, a pattern emerges when you look at the history of these interventions. These hikes almost exclusively occur when a commodity is in a powerful bull run that threatens to bankrupt those who have bet against it. By increasing the cost of holding a position, the exchange creates an immediate cash crunch. It is a filter that removes anyone who does not have deep institutional pockets. The mechanism is clinical. When the margin hike is announced, every broker's computer system scans their clients' accounts. If the additional $3,000 per contract is not sitting there as idle cash, the system issues a margin call. In a fast-moving market, you do not get a polite phone call from your broker, you get an automated liquidation. Your 5,000 ounces of silver are dumped onto the market at whatever price is available. This mass exodus of forced sellers creates a vacuum. This is why we call it a weapon. The exchange knows exactly how much margin is being used across the entire system. They have the data. They know exactly how many traders are operating at the edge of their capital limits. By raising the margin at a critical psychological level, the exchange can trigger a controlled demolition of the price. It is the only place in the world where the house can see every player's cards and then change the minimum bet in the middle of the hand. This move effectively protected the systemic stability of the short sellers at the direct expense of the long speculators who were actually correct about the market direction. To find the true motive behind any massive market move, you must follow the trail of the largest potential losses. In this silver crash, the trail leads directly to a ghost that was haunting the short sellers, the $75 strike price. According to data from financial reports and the Hindu Business Line, there was a massive concentration of 41,000 call option contracts sitting at exactly the $75 level. To the uninitiated, this might just look like a number on a screen. But the physical implications of these contracts were catastrophic for the clearinghouses. A call option at $75 gives the holder the right to buy silver at $75 no matter how high the market price goes. If silver is trading at $88, as it was in Shanghai, those 41,000 contracts are deep in the money. But here is the critical part. Unlike many retail options that are settled in cash, these Comex contracts can be exercised for physical delivery. When we run the math, the scale of the threat becomes clear. 41,000 contracts, each representing 5,000 ounces, equals 205 million ounces of silver. To put that 205 million ounce figure into perspective, it represents a massive portion of the total silver held in Comex registered vaults. If even a fraction of those option holders, such as industrial giants in the solar or semiconductor sectors, decided to stand for delivery, the exchange would face a physical default. They simply would not have enough metal to fulfill the orders. This is the nightmare scenario for any commodities exchange, a delivery squeeze. When short sellers cannot find physical metal to deliver, they are forced to buy it back at any price, potentially sending silver to $100 or higher in a matter of days. The timing of the margin hike, therefore, looks less like a routine risk adjustment and more like a tactical strike against this $75 ghost. By forcing the price down from $88 to $74, just as these options were reaching a critical point, the exchange effectively moved the price below the strike price for many participants. They turned a winning position for the longs into a desperate fight for survival. If the price stays below $75, the pressure on the short sellers to deliver those 205 million ounces vanishes. The options either expire worthless or are closed out for a loss. This single administrative move saved the short side of the market billions of dollars and, more importantly, prevented a total collapse of the paper silver pricing system. The 41,000 traders who were liquidated were not just victims of a bad trade. They were the necessary sacrifices required to keep the delivery ghost from breaking the vault doors open. In the world of high finance, a short squeeze is the equivalent of a predator becoming the prey. It occurs when those who have bet on a price decline are forced to buy back their positions at rapidly rising prices to limit their losses. This creates a feedback loop of buying that can propel prices to vertical, irrational heights. By late December 2025, silver was entering the early stages of a catastrophic short squeeze that threatened the very foundations of the Western banking system. The primary players in this drama are the Bullion Banks, massive institutions like JP Morgan and UBS that often hold massive short positions in silver futures to hedge physical holdings or, as critics allege, to manage price levels. As silver surged toward $83 per ounce, these banks were facing multi-billion-dollar paper losses. But the real danger wasn't just the price. It was the naked nature of many of these shorts. It is estimated that for every ounce of physical silver in a Comex vault, there are over 100 ounces of paper silver traded in the futures market. If a short squeeze had been allowed to run, the bullion banks would have been forced to go into the open market to find physical silver that simply does not exist in sufficient quantities. This would have led to a systemic default. To prevent this, the CME Group deployed the short squeeze defense, the margin hike. By raising the cost of holding a long position to $25,000, the exchange effectively neutralized the buy side of the squeeze. As the leveraged longs were liquidated, the downward pressure provided a get-out-of-jail-free card for the short-selling banks. They were able to use the forced selling of retail and institutional bulls to cover their own losing short positions at significantly lower prices. In effect, the margin hike functioned as a circuit breaker that favored the institutions. This is not just speculation. We see it in the data. While the paper price on the Comex was slammed down to $73, the physical demand in Asia remained white-hot, with the Shanghai Gold Exchange continuing to trade at significant premiums. The exchange essentially created a controlled demolition of the price to provide cover for the shorts to exit their burning building. For the 41,000 liquidated traders, their lost capital was the fuel used to put out the fire that was about to consume the world's largest banks. To understand the present, we must look at the scars of the past. The silver market has a long memory, and what we are witnessing today is a refined version of a playbook that has been used for decades. This is not the first time the rules have been changed mid-game to protect the establishment. The most famous example occurred in January 1980 during the legendary rise of the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt had attempted to corner the silver market, accumulating a massive position that drove prices from $6 to a staggering $50 per ounce. The shorts, which included some of the most powerful brokerage houses on Wall Street, were facing total bankruptcy. To save them, the Comex changed the rules overnight. They implemented Silver Rule 7, which restricted any new long positions and only allowed for the closing of existing trades. Combined with massive margin increases, this effectively turned off the buy button. Prices collapsed, and the Hunt brothers were eventually forced into bankruptcy. The message was clear. If you challenge the system and win too big, the system will change the rules to make you lose. We saw this pattern repeat in April 2011. Silver had reached a near-record high of almost $50 per ounce. The retail sentiment was euphoric, and the short sellers were once again trapped. Within a single week, the CME Group raised margin requirements 5 times in succession. Each hike acted like a fresh blow to a fighter who was already on the ropes. The cumulative effect of those 5 margin increases was a 30% crash in the price of silver in just a few days. The weak hands were shaken out, and the price did not recover for over a decade. What happened in December 2025 is a modern evolution of these events. In 1980, they used Rule 7. In 2011, they used multiple margin hikes. Today, they used a single, massive overnight hike combined with rumored position limit reductions. The goal remains the same: protect the clearinghouse and the major short sellers from a physical delivery crisis. These historical echoes prove that the 41,000 traders who were liquidated this week are not outliers. They are part of a recurring cycle. In every major silver bull market of the last 50 years, the exchange has stepped in to manipulate the cost of participation once the price threatened the systemic stability of the short side. For the professional investor, the lesson is clear. History does not repeat, but it certainly rhymes. If you are going to trade silver, you must expect the exchange to intervene the moment you start winning too much. While the drama of liquidated accounts dominated the headlines in the West, a silent and more profound shift was occurring in the East. To understand the true value of silver, you must look at the widening gap between the Shanghai Gold Exchange and the New York Comex. In a functioning global market, the price of an asset should be relatively uniform across the world, accounting for shipping and insurance costs. However, in late December 2025, this equilibrium shattered. The spread between Shanghai and New York reached an unprecedented $8 per ounce. In Shanghai, industrial users and investors were paying $88 for physical metal, while in New York, the paper price was being suppressed toward $80. This $8 gap is what we call a massive arbitrage opportunity. Theoretically, a trader could buy silver in New York, ship it to China, and pocket an immediate 10% profit. But the arbitrage failed. It failed because there was no silver available in New York to buy for immediate delivery. The Comex had become a market of paper promises, while Shanghai had become the market of physical reality. The massive margin hike in New York was a desperate attempt to close this spread, not by allowing the New York price to rise toward the real-world value, but by hammering it down. By forcing 41,000 traders to sell their paper contracts, the exchange artificially compressed the spread from $8 down to $5. This price dislocation reveals a critical truth. The West is losing its grip on the silver pricing mechanism. For over a century, London and New York have dictated the price of precious metals through leveraged futures trading. But as silver inventories in Western vaults dwindle, the power is shifting to the East, where silver is treated as a strategic industrial asset rather than a speculative chip. The compression of the spread we saw after the margin hike is likely temporary. It was a paper fix for a physical problem. Once the forced liquidations are exhausted, the underlying reality remains. China and India are vacuuming up the world's physical silver supply. If the Shanghai price begins to climb again while New York remains suppressed by high margins, the disconnect will only grow. Eventually, the spring will be wound so tight that even a massive margin hike will not be enough to prevent a violent snapback. The 41,000 traders were liquidated to buy the Comex time, but they cannot buy them more silver. In the chaotic world of December 2025, while retail traders were staring in horror at their liquidated accounts, the world's largest financial institutions were executing a pre-planned maneuvers with surgical precision. To understand the institutional playbook, you must look at the quiet reversal of J.P. Morgan. For over a decade, J.P. Morgan was known as the Silver King, holding the largest short position in the market. But by late 2025, a seismic shift occurred. Reports indicate that J.P. Morgan closed its massive 200 million ounce paper short position during the 2025 rally. Even more shocking, they began accumulating physical silver at a rate never before seen in private history, amassing an estimated 750 million ounces in their vaults. This is nearly 62% of the entire global annual demand for silver held by a single entity. The playbook is simple but devastating. Use paper short positions to keep prices artificially low, buy as much physical metal as possible at those suppressed prices, and then, once the physical supply is cornered, flip the switch to become the ultimate bull. Institutional players do not play by the same rules as you. When volatility spikes, the bullion banks receive preferential treatment from the exchanges because they provide the liquidity that keeps the system running, while you are hit with a margin call that requires cash in hours. Institutions often have credit facilities and balance sheet advantages that allow them to weather the storm or even negotiate terms. In the crash of December 28th, the banks used the forced selling of 41,000 retail traders as a liquidity pool. As you were forced to sell at $74, the big players were there to catch the falling knife, absorbing those contracts and strengthening their long-term grip on the market. Furthermore, the banks have an information edge that is nearly impossible for a retail trader to match. They monitor the commitment of traders' data in real time, long before it is published to the public. They know exactly how over-leveraged the small speculators are. By the time the Comex announced the margin hike from $22,000 to $25,000, the institutional desks had already adjusted their risk. This is the reality of the 2025 silver market. It is a transition from a speculative paper game to a strategic resource war. The banks are no longer just trading for commission. They are hoarding silver because they recognize its critical role in the AI and green energy revolution. They are not afraid of a 30% crash. They welcome it because every crash shakes out the weak hands and allows the strong hands to accumulate more of a finite, disappearing resource. To survive, you must stop thinking like a gambler and start thinking like a central bank. In the wake of the 41,000 liquidations, it is easy to succumb to the idea that the market is entirely rigged and impossible to win. But the truth is more nuanced. The market is not just a place of supply and demand, it is a high-pressure environment with specific rules. If you understand these rules better than the masses, you can move from being a victim to being part of the elite. To survive the next margin hike or regulatory shift, you must adopt an advanced risk management strategy. Lesson number 1. The rule of 200%. Most retail traders operate at the minimum margin requirement allowed by their broker. If the exchange requires $25,000, they have exactly $25,000. This is a fatal mistake. To trade like an institution, you must maintain a cash cushion of at least 150 to 200% above the minimum. If you are trading one silver contract, you should have $50,000 in your account, not $25,000. This buffer ensures that even if the exchange doubles the margin overnight, your position remains safe. You sacrifice some leverage for the ultimate prize, staying in the game. Lesson number 2. Diversification across jurisdictions. We have seen how the Comex in New York can intervene to protect Western shorts. A professional strategy involves spreading your exposure across different exchanges and formats. Do not put your entire silver allocation into Comex futures. Consider a mix of physical bullion stored in private vaults, silver ETFs like SLV for liquidity, and even contracts on the Shanghai Gold Exchange if accessible. By diversifying the where and the how of your holdings, you ensure that a rule change in New York does not destroy your entire net worth. Lesson number 3. Watch the options calendar as if your life depends on it. The $75 strike price explosion was not a secret. It was public data. Major price moves often gravitate toward these zones of high open interest. When you see a massive concentration of call options that are in the money, you are looking at a red flag for exchange intervention. The clearinghouse will always act to prevent a physical delivery failure. If you see silver approaching a level where 200 million ounces might be demanded, it is time to reduce your leverage and prepare for a volatility event. Finally, you must position size for the black swan. Ask yourself, if silver drops $10 in an hour due to a regulatory change, will I be wiped out? If the answer is yes, your position is too large. Size down until you can sleep through a margin hike. The 41,000 traders who lost everything on December 28th were not wrong about the value of silver. They were simply wrong about their own survival capacity. In this market, being right is secondary. Being able to stay right until the market agrees with you is everything. As we stand on the threshold of 2026, the silver market is no longer just another commodity chart. It has become the ultimate battleground between paper manipulation and physical reality. The liquidations of December 28th while devastating to 41,000 individual traders, may go down in history as the final, desperate attempt by the old guard to maintain control over a price that is ready to explode. When we look at the structural fundamentals, the case for silver remains one of the most asymmetric opportunities in modern financial history. Looking ahead, we are entering the 6th consecutive year of a structural silver deficit. Industrial demand from solar energy, electric vehicles, and the massive expansion of artificial intelligence data centers is projected to consume over 1.2 billion ounces in 2026 alone. Meanwhile, global mine supply is stagnant, struggling to even reach 830 million ounces. This massive gap cannot be closed by a margin hike or a rule change. It can only be closed by a significantly higher price that forces industrial users to compete for every remaining ounce of physical metal. Many analysts are now looking past the $74 level toward the psychological milestone of $100 per ounce. With China set to implement strict export licenses for silver starting January 1st, 2026, the supply of physical metal in the West will only get tighter. The 41,000 traders who were shaken out by the Comex provided a temporary reprieve for the short sellers, but they did not solve the underlying shortage. In fact, by driving the price down artificially, the exchange may have inadvertently triggered a new wave of physical buying from long-term institutional players who recognize a bargain when they see one. In conclusion, the message of the December crash is not to stay away from silver, but to change how you participate. The era of easy, low-margin gambling is over. The era of strategic accumulation has begun. If you choose to trade, trade with the discipline of an institution, maintain massive cash buffers, watch the regulatory horizon, and never bet more than you can afford to lose to a midnight rule change. The forces of history are moving toward a remonetization of silver and a recognition of its indispensable industrial value. Those who survive the volatility of today will be the ones who reap the rewards of tomorrow. The rules of the game may change while you sleep, but the physical laws of supply and demand never do. Stay vigilant, manage your risk, and remember that in the world of silver, the most valuable asset you have is not your leverage, but your ability to stay in the fight.